Well, good afternoon, everybody, and welcome to the January 11th edition of Bull Sessions. My name is Mark Robertson. I am joined here by Ken Kavula, and we are here just to share some thinking and some random thoughts and debates and just talk about investing in general, stuff that we think and hope you will be interested in. And you never know, every once in a while we stumble into a gem or a nugget or two. And every January, we do spend a little bit of time trying to maintain perspective. And Ken's been doing some really good work in the background, asking the right questions. Is that the Socratic method again, Ken? Or
That is it, Mark. I usually, most of the time, I have answers for the questions I ask before I ask them. So we'll see if that continues. Okay.
This is life with the professor. I get quizzed all the time, and it's actually quite enjoyable. But you can see right there in the middle of the screen the guys from Trading Places, which, by the way, is a Christmas movie, and quite the interesting message on the stock market in general and just shenanigans in general. But let's go ahead and do some performance perspecting and talk a little bit about, it's been a little bit tough out there to pick stocks for the last year, and just some other things that have come up here recently. Let's go ahead and get the boilerplate out of the way. No investment recommendation is intended. We will talk about a couple of companies in real time. Everything that we do here, you guys all know this, is for demonstration, illustration, all that kind of stuff. And what we are portraying and sharing is the principles and methods of the modern investment club movement as championed by the National Association of Investors, now known as Better Investing in some circles, and perhaps as interpreted by us at Manifest Investing. So you're going to hear opinions. Please do your own homework before making any investment decision. If we own something, we'll try to remember to admit that. I'll admit right up front that I own a few shares of Ardelyx still. Might buy some more. Actually thinking about it. We do hold a webcast known as the Round Table. It's always or generally on the last Tuesday of every month at 8:30 Eastern Time. Come in your jammies with your favorite beverages and enjoy. The rate of return on the selections that have been made over the years, we do manage a tracking portfolio, has been on the order of 18 or 19%. So we do have some fun, and we also do generate some interesting ideas for study. If you want to be on a reminder list for that event and other similar events, send an email to nkavula1@comcast.net. If you have any suggestions for us or questions, follow-up questions, both our email addresses are at the bottom of the page there. Any thoughts, Ken?
No, I think we're all set to go. I need to let you know, Mark, that I have a brand new headset. And if you hear I've been told on other programs in the last week here that they're picking up various things. I can adjust my volume and I can adjust the microphone. So tell me if you're picking up stuff you shouldn't be picking up, okay?
Just please assure me you don't have like a tinfoil on your head or anything like that.
No, it's a really nice one that Natalie bought me for Christmas. So
nice.
It has all kinds of buttons on it and everything, but it has more flexibility and more adaptability than the old one did. So if you're hearing something strange, let me know.
Okay, will do. Kim advises that she's here if you want to watch for her amongst the attendees.
I will do that.
And while Ken is doing that, this is our standing agenda. We will get to these topics. Today we are going to talk about tough sledding, a little bit of groundhog. We are down into the real home stretch this time with about 3 weeks left, a little bit on best small companies, and a variety of subjects. We are still celebrating the new year at Manifest Investing and in the Modern Investment Club movement. All right, one of the things that I wanted to chat about just briefly is I don't know. This falls into the thing we've talked about a few times, the 24/7 investing related news cycle, 24/7, 365, whatever you want to call it. It's just amazing when you see the stuff that is out there and reported by, and I'm using air quotes, Ken, even though you tell me not to, financial journalists. The one that really kind of got me last week was everybody was in an absolute uproar over a huge downward day or a downward week with the S&P 500 and the NASDAQ. And I'm looking at this chart, and over there on the far right, they were actually talking about that candle that's shown on this red arrow here. And maybe I am completely missing something about the world, but I don't look at this candle, this red candle, which is basically the amount of swing in 1 week, as anything terribly unusual. And I can find a whole bunch of them on here, even within the last year, that are similar in magnitude. And I guess I'm just complaining out loud that I sit there scratching my head, listening to these guys talk, and just kind of wonder, where is this coming from?
I'm flabbergasted, Mark, at the panic that seems to set in among some of these broadcasters at 3 and 4% drops from all-time highs, from record highs, and suddenly the doom and gloom is palpable on the sets a lot of times, and it seems to last for a period of time, and then they move into something else, and a week later they're talking the exact other direction. They're so happy because the market's going the other direction and going up, and I can't get excited about some of these moves, and the only thing that makes it even worse is this continued emphasis on trying to decide whether you should buy growth or value. I'm screaming at the television set sometimes, asking them to define what the heck it is they mean by value. What exactly are you talking about? Because it certainly isn't the classic definition of what a value stock is.
Oh yeah, if it's got to fit in.
I'm just thinking drama sells.
Yeah.
And I think that the more they drum everything up, make it so gloom and doom, so wonderful, then the more volatility's in the market, it's.
Yeah, I think we might have you're dropping out
when they say, yeah, everything's good.
Yeah, it's an amazing thing. So I thought, well, maybe it's the NASDAQ. And yeah, the bar last week was a little bit big. It certainly was a bit of a dip down. But again, I think I would make the point, I didn't actually count them, but there's probably 20 equally sized red bars on this chart. I mean, if not more. And these are weeks. These are weeks in the NASDAQ going 5 years. And the NASDAQ 100 Trust here, so the QQQ. So again, Ken, your homework assignment is to find 2 consecutive days where they answer the question, the market went up today with a blank, and the market went down today with a blank, and they fill in the same thing 2 days in a row.
I told Mark before we started the session, because he said this before the session, and I told him sometimes I think I can find that example within a 4-hour period. So we'll see if I can do it in a day period. We're getting a really good comment from our friend from Houston, Matt Spielman, and Matt is saying we should just take it for what it is. A lot of times they're generating some pretty decent buying opportunities by their emotion being added to the market. So
Absolutely.
I'll give you that point 100%, Matt. Maybe they're driving something down or pushing something up even more than it would have been without their interest is a good word to put attached to that, I guess.
Yeah, I guess it's stop shaking your head, listen to Kim's ka-ching, and hit the buy button, I guess. All right. Well, back to our normal slides, which again keep things in a much longer term perspective. These are quarterly numbers that you're looking at on the chart. You can see that the market has recovered substantially and has been kind of floating around pretty close to 10,000 for the value line arithmetic average, the green bars. And we are floating down pretty close to historical lows, not anything to panic over. But again, we just like to keep this in context. And what I thought I would share is Morningstar brought back their chart. Now, this has been missing in action for a few months. The market fair value going all the way back to pre-Great Recession back in 2008, 2009. And again, what you're looking at here is the entire Morningstar universe and the price to fair value ratio. So 1 would be 100%, in our language. Anything above the line is potentially overvalued. Anything below the line is undervalued. So it's kind of like the inverse of that chart we look at all the time. Price versus return forecast, basically the difference between the two. And I just thought I would put these kind of both on the same page. You can see that this peak on our chart corresponds to this one here, and this peak back from the COVID moment corresponds to that one. I think I got those right. And what this is basically saying is that the average stock is pretty fully valued right now. And like I say, this has been missing for a while. And I do have a little hint down there at the bottom. If you go outside the value line standard edition and look at the other 1,000 stocks, the Morningstar price to value, fair value, is probably interesting, potentially attractive.
I saw a set of numbers, Mark, on CNBC this morning, coming from an analyst, not coming from any of their normal contributors, but he was on one of the programs, and he made the point that we make a lot of times, that since the mid-20s, the S&P averaged return for any given years hovered around 10%. But he did take it one step further, and I think it'd be interesting for us to take a look at. He said that in this century, that average is closer to 14 or 15%.
Yes.
And he says that might portend reversion to the mean. And if he's correct, then reversion to the mean means that we're going to need some sub 10% years to kind of balance out this series of a hyper 10% years to end up with that long-term average to stay around 10 or so. So I just you have the same figures right there on that chart. Wonderful. And
this bounces off your favorite histogram that we talked about last week.
Absolutely. And
the 5-year returns.
I did like him bringing in this concept of reversion to the mean, because I'm a firm believer that over long periods of time, numbers can speak to you. Now, I'm also a firm believer that over long periods of time, numbers can change their code a little bit. They can change the way they present, and new trends may or may not be established. So it could be that we're establishing a new trend on the S&P where the average is a little bit higher than 10. But if that average stays around 10, then this average of around 14 is certainly atypical, and we should be not concerned about it, but aware of the fact that that might portend for the next decade or even decade and a half, that might portend slightly lower yearly returns to kind of begin to balance that out. Now, he didn't make any predictions, and I'm not making any predictions either. Sometimes numbers don't behave in rational ways when they're based on real data, and a lot of times trends take a much longer time to develop than a week or two. So with all that in mind, I think the point is very interesting and very important for us to keep an eye on.
Yeah, and of course this underscores in rather bold fashion, these are 5-year rolling periods. So, what you're looking at on the far left is the returns over the 5-year period from 1980 to 1985. One of Ken's favorite things to point out is that if you do this over a long enough period of time, you can basically take out any negative results over a longer period of time, with one notable exception, and that happens to be 2008, where the 5-year actually dipped down negative. But yeah, and one of the other messages I get from this chart is we're not in terribly unusual times right now. This is not terribly unusual over here. People have been speaking about a dramatically overheated market. Yeah, it might be a little warm. I don't know.
Well, and it's a little warm compared to 2018 and 19 also, but these kind of ups and downs and these considerable shifts, between the 5-year periods. Remind yourself as you're reading the chart that these 5-year periods all overlap each other. So when I look at 94, which is, right close to 10, maybe just a little bit under 10, that's 89 through 94. But when I look at 95, that's 90. I said 89. That's 90 through 94. And when I look at 95, that's 91 through 95. So they have 80% of the same data included in the two things. It just tends to smooth the curve out a little bit. But even smoothing it out, you still get some gigantic moves relatively in some of these 5-year periods.
Yep.
Again, I think this tells retired people that you can comfortably take out 3 or 4 or 5% of your nest egg on a yearly basis, and probably have enough money to continue to live. If you start off with a nest egg that's it doesn't have to be 3 million or 4 million or 5 million. It probably could be something that's reasonable at the end of a hardworking career with some legitimate savings going on.
Absolutely. And this period in time that I've kind of boxed in here, that was the go-go 90s, the end of the 1990s decade. That was a very good time for investment clubs. This was not a good time, and neither was this. Both made it a little bit tough, especially on the newcomers. All right, so back to here. So that's that chart. And then this one came up. This is one, I don't know, we'll scratch our heads over this and decide what we think. This is actually a report issued by Morningstar this last week. And Ken is just yearning for this to be in some form of palpable English. The way I would describe it, I'll give you my first reaction. I'll turn it over to you, Ken.
Great, Mark. Great, yeah.
The numbers are too big. There's just too much chaos in some of these numbers. And I'm particularly focused on the last year and what I've seen, this type of stuff doing to some of our database entries. And, when you think about in an average year, you would expect the fair value to change, 10 to 20%, maybe 0 to 20% for the vast majority of your stock studies. And I'll just leave it at these numbers are way too big and they make me uncomfortable.
Well, I think what it's pointing out, Mark, is that maybe Morningstar's method of calculating fair value is I hate to say this, and I'm going to get pounded on the head for it, but maybe it's just a little bit too conservative. If it allows this much change in a positive direction over a 1-year period for the numbers of stocks that we're looking at, then maybe it just starts out a little bit too low at the beginning of the year. The way I interpret this chart is that we'll take that tan section that you circled up there, that looks to be maybe 5% of the sample, and we can argue as to how much it is, but it is what it is. It's up there. You can see it. And that means that many stocks have increased their value from the fair value, whatever it was on January 1st, 2021. They've increased their value, their actual value, more than that same amount over the year. And so that on December 31, if it was worth $100 on January 1st, then it's worth more than $200 on December 31st. So, and that 100 goes up to 100 plus, so there is no top limit to it. I'm especially intrigued by that dark blue section, which is a quarter of the sample, and which says that between about a quarter of the entire stock market, because Morningstar does cover most of the investable stock market, about a quarter of the stock market increased its value from anywhere from 25% to 50% over that particular year. Well, I'm just amazed that the numbers are this large, and I'm amazed there's not a little bit more balance to the whole thing. I would expect there to be a little bit more in the red portion, in the negative portion, because to have a market, I think you have to have losers as well as gainers, but maybe those losers are really, really big, and that kind of balances out what's going on. I don't know.
Yeah. Well, there's
Uh,
a lot of
but
strengthening fundamentals. So
yeah,
I can sort of forgive them a little bit for that, but I mean, I just leave it at the numbers are too big. And
yeah,
what I have witnessed in terms of the disruptions, from analysts over the last couple of years, I'd be the first to admit we all know this. Forecasting ain't easy, but wow, I have seen so many companies here in the last few weeks. I've highlighted a few of them where companies like Intuitive Surgical will go from $140 fair value the next week they're $380. That's just showing. It's a symptom. It's a symptom. We've always talked about it. This kind of puts it into kind of stark relief that, especially with early stage companies, they're among the type of institutions that seem to struggle a bit with that. So we'll just leave it at that, and maybe we'll look at how much impact this has on our situation and come back to it. So with that, in the spirit of forecasting not being easy, we've been beating up on our groundhog nation here for the last year or so, and this actually gives us a little bit of relief because we can say, see that, we're doing better than the other guys who are really stinking up the joint. I mean, when you see this number and you start looking at the raw numbers, it's pretty stiff. We're back into one of those years where 85 to 90% of the professional stock pickers are not keeping up with the S&P 500. So that actually makes this statistic a little bit more easy to swallow. We're beating them. It's one of our weakest performances in 15 years, but we're still hanging in there. So again, misery-loving company. At least we have that situation going on. Here is the current status of the groundhog. I know we had some disruptions in tickers. I apologize for that. It really messes up the downstream side of the manifest investing database. Keep in mind that what you're looking at here are the official standings. All of those price disruptions don't happen at Y charts. So these stay very consistent, and they're good minute to minute. And so Ruth is on top. Warren Buffett is making a heck of a run for it. Ken is still in the top 17. He'll ask for a recount if he drops much further.
I bounce around day by day, Mark. I bounce around 8 or 10 points on a typical day. So maybe if you look at it tomorrow or the next day, I'll be in the top 10 again. I don't know. We'll see.
And that's a good subject to bring up because I actually got within at least one horizon of this chart not too long ago. And that's why I was compelled to put Vince Lombardi on the page, because Vince Lombardi used to always say that his Green Bay Packers never lost a game. There were a few times when they ran out of time and they were behind on the scoreboard, but they never lost. So that's kind of my philosophy too. If I don't make this page by the end of the year, it'll just be because, it's an artificial stoppage of the clock. And yeah, if you think I really believe that, all right.
We're getting a question, Mark. When people look at the portfolios that are attached to these names, they don't find a portfolio attached to Warren Buffett. Where does the number for Berkshire Hathaway come from for Warren Buffett? Is that just a measure of the Berkshire Hathaway stock?
Yes. I mean, one entry for Berkshire Hathaway. And in case you hadn't noticed, it's up to almost $500,000 a share. So, yeah. All right.
So what happens, Mark, when the entire market starts to become index investors?
Is that a question from the audience?
No, it's a question from me. What do you think happens then? I guess the underlying question is, at what point does index investing start to really mess with the numbers of the individual stocks?
Yeah, and I'll tell you, this is a subject we could perhaps even do a breakout session on at some point. And the moral of the story is that it already is. You know, with all of the 401k and the passive investing that's going on, just literally churning capital into, just take the S&P 500. I think all of us here believe that there's a few companies in the S&P 500 that are kind of weak fundamentally. They're getting that money no matter what when it's index investing. People are not choosing to invest directly in them, but they're getting kind of this artificial capital flow. And it's something that Ben Carlson has talked about quite a bit. Companies that don't necessarily deserve it, and I'm using air quotes again, are getting that money. It's providing kind of an artificial price support. So realizing that it's there, you take advantage of it.
So does it maybe tie in, Mark, to what we were talking about 10 minutes ago about the performance of the S&P in the last 10, 15 years versus the long-term performance of the S&P?
Yeah, I think so. I think it probably does provide an artificial level, along with everything else. It's kind of hard to tell with all the variables in place with what the Fed's doing and everything else. But yeah, there is a disruptive element to it for sure. Could be a good topic. I'll consider adding that to the list for a future session or a future breakout session, because it could
we have
be fascinating.
a question from our audience here, or from a couple folks. You were referencing the Berkshire A stock up in number 2, right, on the Warren Buffett portfolio?
I believe so, yes.
And the Berkshire B stock is nothing more than a division of that number. Am I correct in saying that?
Yes, 1/16.
Okay, so they're just tied together arithmetically. They're not different investments, really. One of them just can be bought. You're actually buying a fractional share when you buy the B stock of the A stock, right?
That's correct.
Okay.
All right, so this one, we're actually coming down. What I thought we would do a week from now, Ken, is just take a look back at something we've already talked about, how many stocks in these various portfolios. Again, I think it's a better, if you want to try to win, I think it makes a lot of sense to pick fewer stocks. We'll go back and look and see how many stocks have been chosen by previous champions, that sort of stuff. But also just a reminder to everybody, start your shopping engines for Groundhog 16.
Yeah, we have Jennifer out in the audience, Mark, and last week she was wondering if this was real money, and I assured her it wasn't. These are mock portfolios, Jennifer, and you're given $1 million in Groundhog dollars on February 2nd, and encouraged to submit a portfolio of. Give me the numbers, Mark. 5 to some odd stuff, 5 to 20 maybe.
20,
is that
yeah.
right?
Very few
5
people
to
do
20 stocks, yeah. So you can start getting that portfolio put together right now if you'd like to be in next year's contest. And all you have to do is get it to Mark by the 2nd of February, and you've then entered. You just need to tell him what stocks you want and how many dollars of each one. And the dollars need to total $1 million. That's the way it works.
Yep. We generally divide them up equally amongst the 5 or 6 or 8 investments. But there is a legend that there is a groundhog-based cryptocurrency, and that these dollars just might be real currency in Punxsutawney, Pennsylvania. So, Ken, you and I should probably go check and see if we can spend it.
We need to go on a road trip. I knew that was coming, Mark. Okay.
All right. In the spirit of being a tough year for stock pickers, a few have had a tougher year than Kathy. Kathy is quite accomplished. I'm a bit amazed that she's dropped down to 3rd place on the 10-year performance chart that we use for listing people who seem to know what they're doing. They've been at number 1 for quite a while. And finally, it's taken its toll. Some of the stocks that are just not working out very well. I have a lot of faith in the long-term perspective for what they do. But another one that I find kind of interesting is Ron Barron and his partners retail. I had no idea, but that's 50% in Tesla. And that explains some of the lower numbers that you see for the return forecasts. But kind of interesting. I thought ARC Innovation would stay at the top of this list for quite some time, and a rather sizable relative return column on the far right has been brought back to earth. So that's why you're seeing so much said and written about her.
One of my favorite words, Mark, in all of vocabulary is Schadenfreude, and that's a German word that is taking great pleasure in the misfortune of others. And I'm amazed at the pleasure being taken in Kathy Wood's decline in performance by some of the commentators on CNBC.
Yeah.
They almost cackle when it comes to talking about how poorly right now the ARC fund is doing. It's amazing how quickly friends can turn into they're not exactly enemies, but boy, they appear to be very happy with her misfortune at the moment. So.
Yeah, and in the spirit of what Matt Spielman was talking about, when the rhinos and talking heads are beating up on whatever, and that whatever lately has been right here, technology, believe it or not. There's a lot of very strong technology funds, exchange traded funds, and mutual funds on here. I am really sorely tempted to look at that number 17, equally weighted technology, because that's going to give more emphasis. It's the opposite of what we were talking about a few minutes ago, Ken. You would be investing across the whole thing, and the cap weighting would be subdued.
Absolutely, yeah. A lot of these funds, and our friend Len Douglas makes the point continuously that a lot of these index funds that you're investing in are capitalization weighted, which means the bigger the company, the more of the price and the more of the money that you invest goes to that bigger company. There's cap versions, cap weighted versions, and equally weighted versions of most of the major indexes, aren't there, Mark?
Absolutely. So
yep.
Take that into consideration too. So again, in line with what Matt was saying, I'm tempted to buy a few shares of a technology fund. Perhaps one of those is circled on this page, just to take advantage. Of course, one of your favorite pundits will probably be on TV messing with that here shortly. So
even that semiconductor fund that's number one right now, Mark, is probably filled with some very interesting companies at the moment.
Yeah, absolutely. All right, here's again for perspective, longer term perspective. We featured this during our questions session with the investment club last summer. Here's the update through the end of the year. There's a lot of things that could be taken away from this. The first thing I discovered in looking at average investor returns, either from the work done by Dalbar, some other academic research into the effect, and Morningstar that keeps track of investor returns versus fund returns, that's all suggesting that individual investors are actually doing a little bit better job of keeping up with the general stock market, even though you can see that it's lagging a bit. Those two, the second entry and the third entry on the page. This again suggests this little difference here suggests that some of those smaller companies probably have some outsized long-term potential if you can find them. And of course, the Wilshire 5000 over the trailing 5 years is checking in at about 18% at this point. That's huge. Again, Ken's regression to the mean is probably, or reversion to the mean, is probably an eventuality. But again, we're quite happy with this situation. And the last 5 years for all of those components, either at the round table or tin cup. And amazingly enough, the Manifest 40 has been bolstered by the size of our commitment to companies like Apple, Microsoft, Google. And that's pushed out that blue bar up a little bit further than I normally would have expected. And you can see that the return for the BI 100 total return index is pretty robust also, basically taking out the market. Somebody had asked a question as to, what's that tell you about the experience of investment clubs? And Ken, feel free to correct me on this one, but I look at the BI 100, which I'm not even sure they still do, as being very, very large company dominated.
extremely large company. It's still published once a year, Mark, and it's extremely large company dominated. It's full of legacy holdings from older clubs where they're holding thousands and thousands of shares in some cases of some of the larger companies, and that tends to push up. It's also not calculated by taking the actual portfolios of clubs anymore. There's not a call put out for your portfolio like there used to be,
Okay.
but rather I think they're examining the records of clubs that happen to use the iClub accounting programs. So if your club uses a different accounting program, it's not part of that data. And if your club is still doing accounting by hand, and first of all, my condolences to the treasurer if that's happening. But if your club is still doing hand accounting, and I do know clubs in my own chapter that are doing hand accounting yet, then that data is not taken into account either. But I think the reason for the BI 100 being so full of large companies is mostly due to legacy holdings of very old clubs.
Yeah, it's no different than the media bias. If you watch TV, you're going to hear more about Microsoft than you are some of our favorites. The thing I pointed out to people is I don't think it's necessarily reflective of the investment club experience. And the names that I would drop to suggest that and kind of drive the point home would be companies like 26 or Neogen. They're not in that BI 100 total return number, but they are definitely a part of the investment club experience. And I just use those as examples. There's obviously many others. And without those factored in, it's kind of hard to really characterize the experience. All of the
I will.
Go ahead.
I'm sorry. Go on. Okay, I will say, Mark, that new high momentum stocks with a lot of publicity break into that top 100 pretty regularly. NVIDIA is a good example of that. That it will break into these lists because it is very high momentum and it's talked about by a large part of the financial community. The people that talk about stocks 24/7 that we've talked about before, they pick some favorites, and those companies, whether they're large, medium, or small, also tend to be followed then very closely by a lot of our groups, a lot of the clubs.
So again, the experience of the model clubs, at least that I'm familiar with in this area, pretty strong, and not necessarily related to that number. And then, of course, that little hint at the bottom. Our best small companies for the last 5 years have a return of 24.3%. So that's kind of makes the point that you invest in those type of companies carefully.
That little upward pointing arrowhead is called a carat, CARAT, and it's the symbol that's used for a radical sign. That's sort of like a long division sign, folks, and the 2/10 after it, expressed as a fraction, is 1/5, which means we're taking the fifth root of that quotient right there, of that division of the 837 divided by 362. We're taking the fifth root of that number. No, you can't do that by hand. You need yourself a calculator, and this is the way that you would type that quantity into an Excel spreadsheet in order to come up with the answer of 0.182 or 18.2%.
Just the teacher in you never leaves, does it?
Well, we have a couple of folks that don't understand that. So
no, I get it. I'm not being critical. I was admiring. I wasn't being critical. All right, we've already looked at this one. Again, context matters. Here's a really hot stock tip for you. Stock prices fluctuate. All right, Ken. So now let's talk a little bit, just for a moment, about the best small companies for this year. We're getting a little bit of a spread here, and you complained that that scale, the y-axis scale was kind of tight. We're getting a little bit here. Both the traditional, which is the buy and hold, buy and forget version of our 20 small companies versus the active, which is, we did replace eHealth with Pachira Pharma about a month ago, maybe a couple months ago now. And
it looks like we have $12 or $13 between the traditional and the active, and it still does only represent a single stock right now. So
yeah, but at least it's above the green one. That's what we like, and we're actually we're being kind of defiant here because Ken used to forbid me from even talking about this until next Halloween. I say we're just walking right into the gunfire this time. I mean, this is just going right at it. Anyhow, here's our point of view summary of these companies, and Gentherm has been doing very well, so well that it could actually, if it gets a little more momentum, could be one that we actually consider replacing in the portfolio. But you can see from top to bottom, a lot of pretty decent return forecasts, a lot of consistency between the projected return numbers and the projected return on value and the return forecast, the projected annual return. And you can see those side-by-side numbers. Here's an example, Ken. Look down there at Sharp's compliance. And you see the 38 number. That's just a weird number. I mean, that's just one example. For the Morningstar price to fair value. Kim may want to back up the truck on this one, but I'm not sure. I think that 38 number is terribly credible. So
well, that 123% ACE total return numbers also kind of an outlier on the list, Mark.
Yeah.
Same company.
Could happen.
Yeah.
Right.
I think we're going to have a very interesting discussion when it comes to moving out stocks at the top of the list.
Yes.
Because I'm not sure that a month is long enough to measure a high momentum stock. You know what I'm saying?
Yeah, what that's really intended to do is to take a situation like we had with Pat Donnelly and Stone Co. in the successful investing panel. You know, his $10 stock went from $10 to $40 in a few months, and then went back to $12. So yeah, you want to be watchful of that type of a selling opportunity in a situation like this. That's all we're really trying to do there.
So maybe something akin to a trailing stop loss that we kind of monitor ourselves might be something that we'd want to do at the top end.
That could make sense. I mean, we're nowhere near that with this situation, but yeah.
Right, right.
Yeah, I mean, a trailing stop loss on Stone Co. following Pat's selection would have been very rewarding. All right, here's one of the companies just to give a quick update. A lot of strength here. This is Ann Cuniaz's selection of Medifast during the most recent panel session. It's part of the best small companies. Basically still firing on almost all their cylinders. The analyst expectations quite strong. And it's not to say that it couldn't come crashing down or falling apart, but this is clearly a company that has changed and continues to execute. You see a projected return of 17, a projected return on value of 17, no debt. Ann loves companies with no debt. And we like it in its position in the portfolio also. So I don't see this one as having any trouble at this point. We will try to update these type of companies as the year goes by.
Well, and this one's just behaving like a textbook example right now, Mark. There's you go through all the numbers and you say to yourself, well, that's where it should be. That's what it looks like. That's what it's doing. Mm-hmm. So it's just a great example of the methods that are being used to come up with pretty decent stocks.
And this is also an opportunity to touch the tip of an iceberg we were talking about before we came online. And Ken asked about, where the analysts have been disruptive. It was kind of following on the heels of that Morningstar discussion of, what Morningstar has done in terms of turbulence to RPEs. And one of the things I pointed out to him was that the value line 3 to 5 year estimates have been weird. And they're that's sugarcoating. And you can put up company after company where you see this type of a situation. They could be right, but they really have been different than the analyst consensus, and that does have some impact on our database. And in some cases, it was unwelcome impact from my perspective. And you can see that dot is fairly significantly, it's a little hard to see, but fairly significantly below that long-term trend line. And like I say, they could be right, but boy, those numbers being that far off of those lines in literally hundreds of cases made for some disruption, in my opinion.
Well, I'm noticing a number of examples, Mark, that get even a little bit more granular than that. I'm noticing examples where after 2 quarters, I'm looking at an earnings number for trailing 4 quarters that is above the end of year value for 2021 or 2022 if I'm in that fiscal year.
Mm-hmm.
And that I don't want to use the word sloppy because I don't know the methodology, but it does point out that maybe the models that are being used aren't taking fully into account some of the rapid increases in earnings that have occurred as some of these companies caught up from the COVID closures. So whether they, I don't know whether the model is saying that those numbers are not typical, they're not going to be maintained, and therefore we're going to take them down, or what is happening. But I think you're correct that value line future estimates for a lot of companies, especially faster growing companies, have been a little bit out of perspective with what I usually expect to see from value line.
Yeah, and it's actually in many cases worse than this. I mean, look at this situation here where you could draw a trend line for those earnings, and I'm exaggerating up there. Here's value line. So I'm thinking maybe they're allowing drinking on the job, and late on a Friday afternoon they just forget to update that number on the far right. I don't know.
Yeah.
But the other thing is, they could be being pessimistic. They could be being reasonable. But just leave it at that. I mean, that's where some of that disruption has come from. All right, here's your reminder that we do archive all of the sessions, the bull sessions and the roundtables, the successful investing webcasts that we've done on YouTube. You're invited to go there. Just search for Manifest Investing. Please subscribe if you'd like to receive a reminder anytime we add new content. And we will have this session up and running if the internet is cooperative here and we don't have to rebuild after this. And with that, we'll leave with a picture of Vince Lombardi and the clock running out on my groundhog portfolio. That's a great book, by the way. When Pride Still Mattered. And, of course, that Christmas movie Trading Places on the right.
Orange juice futures, right?
It was Orange Juice Futures, yeah.
I know.
And aren't you impressed?
I really like this movie.
Yeah, it should. Aren't you impressed that I didn't put a picture of an ape on there anywhere?
These are two of my most favorite actors, so I like that movie.
All right. So, anything else you want to add, Ken, or things that we should dig into a little bit deeper?
No, I think that I've kept up with the questions pretty much, and thank you for an interesting discussion. And I don't think we have much else to say until see you again next Tuesday.
I will do some head scratching over that macro topic you described with the passive investing, and I would be more likely to read up on that than inflation.
I know. Good night, everybody. Glad you were here.
Take care, everybody. Thank you.